Hi everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market updates. In this video, I'm going to talk about the treasury yields. In the early hours of November 28th, the US Treasury issued $54 billion of two-year treasury bonds with the auction rate of 4.887%, the lowest since July and down 16.8 basis points from the auction rate in the same period last month. This is mainly due to market expectations that the Fed may cut interest rates in the middle of next year, making the two-year treasury issue lower from the previous month. Of Wall Street bond brokers, but to the market's surprise, the two-year treasury issued the bid rate by 1.1 basis points, suggests that the Treasury was forced to lower the two-year Treasury bid, indicated that the two-year Treasury issuance suffered weak purchase demand. In contrast, the bid multiple for the two-year bond issued was only 2.54 times, down from 2.64 times and the lowest since March, and significantly below the average of 2.81 times for the last six two-year bond issues. Data shows that in the bidding process of the two-year Treasury bonds, overseas central bank and other official institutions and overseas private investors received the allocation, the lowest since March, down 4.7% from the previous allocation of 62.1%. In the face of weak demand for overseas capital subscription, the Federal Reserve and the U.S. government have once again become the successor. The Federal Reserve and other federal entities, as direct buyers, received 23.4%, the highest level since March. To avoid the two-year Treasury auction, primary traders such as Wall Street had to get 18.8%, the highest since April. The Wall Street bond brokers told reporters, overseas central banks have low interest in two-year Treasury notes, mainly affected by the first three major factors. One is that the current Treasury yields within 1 year are above 5.4%, making overseas central banks more willing to buy higher-yielding U.S. Treasuries within 1 year in the secondary market. Thus, re-up high return to maturity. Second, due to the previous long-term and short-term U.S. Treasury yields inverted impact, some overseas central banks have taken heavy positions in the short-term Treasuries. Based on optimizing the structure of U.S. Treasury holdings, these overseas central banks have no plans to add further two-year Treasury bonds. Third, some overseas central banks need to reserve more U.S. dollar positions for the maturity of payments of U.S. dollar-denominated national bonds, affects their enthusiasm to subscribe to the U.S. debt. In his view, an important reason why overseas private capital is also cooling interest rates in U.S. bond purchases is that the market expects the Fed to cut interest rates in the middle of next year. Reporters have learned that compared with the U.S. Treasury bonds, many overseas private capital will focus on the U.S. high credit rating corporate bonds and institutional bonds because the safety of such bond is similar to the U.S. Treasury bonds, but the former yield is about 20 to 40 basis points higher, which can bring more considerable investment returns. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.